All right, let's jump in. Jeff, this is so exciting. Somebody used the word inventoriable costs versus business period costs. What the heck are they talking about?
These are primarily costs, if we're talking about flipping properties, these are costs that you have to add to whatever you paid for the property when you purchased it. So you have your initial purchase cost, you have your improvements that you're doing, and then you have certain other expenses that are directly related to that property, such as real estate taxes. If you have a loan, you probably have mortgage interest. You may have HOA fees. Things of this nature are all directly related to the property, so they have to be inventoried rather than expensed.
Sounds really exciting, but in English, what it means, I love accountants. The Your ability to write something off. So it's kind of like this. If I have a mini mart and I buy Cheerios and I carry them as inventory and I buy a dozen boxes of cereal for $1 each, I don't write off the $12 I spent on them. I don't write that off as an expense. That's basically what we call a cost of goods sold. It's basically buried in. So when I sell it, I take the proportionate amount of that against that inventory. Technically, we do this once a year by taking an inventory and figuring out how much did I add, and then you take the ending inventory and subtract that off, and that gives you the amount that you spent on the inventory that was in that sold during the year. In a flip, a little bit different, right, Jeff?
Correct. Especially when we talk of cost of goods sold, for large companies, this gets really complicated because you have to include expenses that you would never imagine would be
even like shipping and things like that.
Correct.
So a lot of folks, they'll go out, they'll start a business, they'll buy a whole bunch of inventory. They won't make any money, and they're thinking that they're going to, and then they wonder why they owe taxes because they didn't sell a bunch of the inventory. Well, that's why people dump their inventory at the end of the year, is that way they can take their cost of goods sold and offset the income that they're bringing in. So hopefully they have enough cash to at least pay some of the taxes. It's kind of a sad situation to be in, but it's the reality. That's why you see people blowing out their inventory at the end of the year.
So yeah, going back to the whole flip, some of these expenses you may not be able to deduct currently, but when you actually sell the property, that's when they'll help reduce your gain.
Which is why we try to flip our properties within 90 days to 180 days. You don't want to sit there and hold on to them forever because you don't get to take the expense.
It gets really expensive.
Yeah, and just remember, a flip can be held for 10 years. We actually have cases where they still treat it as a flip. What matters in a flip is what was your intent when you bought the property. So it doesn't matter how long you actually held it. What matters is what you actually intended to do when you bought it. So if you're flipping a property, it's not uncommon to go through a tax year and sometimes going even over a year. It's still treated as dealer income, not the greatest. So just be aware of that. Hey, how do we get into all that fun stuff?